It's Jason Waters again with the Jason Waters team at Affinity Home Lending. Today I want to talk about interest rates, what drives interest rates, why they go up, why they go down, and hopefully answer some questions that is on most borrowers' minds. First of all, we'll talk about market conditions, and then we're going to talk about your personal conditions that impact rates. Market conditions, what are those? The big driver for interest rates, and a lot of people look at where mortgage-backed securities are really where you can follow mortgage interest rates. That's loosely follows the 10-year Treasury. That's what a lot of people talk about. They look at the 10-year U.S. Treasury note to see where rates are heading up or down. So when the Treasuries go up, rates go up. When Treasury's down, rates down. So they kind of follow each other, but not always. What drives these bond rates? Well, the driver of the bond rates, number one, is inflation. So if inflation is high, rates tend to be higher. Lately, you've seen, as of the time of this recording, inflation has been higher than it has been in a long time. Inflation can be driven by, for example, government spending. There was a lot of government spending during COVID, creates more debt in our economy or puts more money into the economy, and a faster economy causes more inflation. So that is one of the reasons would be inflation that drives interest rates. When you see inflation start to come down, you'll see rates start to come down. Another factor would really be Federal Reserve policy. So if the Federal Reserve Bank, although they control what's called the Fed funds rate and prime rate follows that, that doesn't exactly impact mortgage rates, but typically when that's higher, rates are a little higher. The Fed also controls a lot of the economy or the bond market through open market operations. So they can buy bonds or they can sell bonds. So what happened during the time of COVID is people put more money or the Fed bought more bonds and bought more mortgage-backed securities and pumped liquidity into the market. Also led to more inflation. Now they're pulling back on that because they want to get inflation under control. So Federal Reserve policy really also impacts rates. Even though it's not as direct, it absolutely does. General economic conditions are kind of tied to inflation growth. If the economy's growing, rates tend to be a little higher. If the economy's slowing down, rates tend to be lower. So those are three very big factors for how economic conditions impact rate. Now, personally, how does that impact your rate? Credit score, we'll start with that first. So the higher your credit score, typically the lower your rate. Why? Because if you have good credit, you're a lower risk to the lenders. Makes perfect sense. So if we think about personal factors in relation to risk, that's kind of where we're going with this. So credit score, higher credit score, lower risk, lower credit score, higher risk. Loan to value, which means how much money, how much equity do I put into this house? If I'm only putting 3% down, that's a higher risk loan. So therefore, they're going to have a higher rate. 20% down, 25% down, typically the rates are better, also risk adjusted. The final thing is the use of the property. Primary residences have lower rates than investment property. Why? A borrower is more likely to hold on to their primary residence during a bad situation. Those are the main factors that drive interest rates. I'm always happy to run individual scenarios, talk to you about where I think rates are going or not, and give you the best advice I can. Follow me on social media, and I will make sure I give you the best information possible. Until next time.